Hi, David. Is there an issue? I see you have your hand up.
I think that's David Rose from
I
the
know, but
Observer.
because as I started speaking, they raised their hand. So I just want to make sure that all the features are working. Is
Okay.
everything okay, David Rose? Good morning, everyone. Welcome to SYGNUS Real Estate Finance Limited's earnings call for the third quarter ended May 2023. I am Justine Powell, and I'm a part of the investment management team, and I will be your moderator for today's call. We do appreciate you all taking the time to join us and learn more about our recent financial performance. During the call today, SRF's management team will discuss the financial results for the quarter ended May. We'll also provide some updates on the business operations, and we'll outline our plans for the future. Following the remarks that are prepared today, we will open up the call for questions from our investors and our analysts. And so at this time, we do encourage you to submit your questions using the Q&A segment of the platform so that we can address them a little bit later. Before I begin, I do want to remind everyone that the presentation and the discussions today may contain forward-looking statements, and those are subject to various risks and uncertainties that could cause our actual results to differ materially from expectations. And so we do encourage you to, alongside the presentation, to take a look at the published management discussion and analysis, as well as our last set of audited financials, to get a more detailed discussion of the risks and uncertainties that could affect SYGNUS Real Estate Finance Limited. I'll also take this time to introduce our presenters. So we'll have two main presenters for today: our Executive Vice President and Chief Investment Officer, Jason Morris, and also our Vice President and Head of Real Estate and Project Finance, David Cummings. So at this time, I do want to turn over the call to Jason Morris.
All right, thanks, Justine. Morning, everyone. So let's jump right into it by going to highlighting some of our major achievements during the 9-month period. So there are 4 key items I want to highlight. Of course, SYGNUS Real Estate Finance is a specialty real estate investment company that utilizes, flexible capital in the form of debt and equity to deploy across all channels of real estate. So the first item I want to highlight is the fact that the build-to-suit industrial property, aka Spanish Penwood, is virtually complete. It's not at 99%. Of course, we have a lot of finishing works to complete. But safe to say that we are almost done with this. We have already received the security deposit, and the first lease payment is incoming. So that means that we should be exiting this transaction shortly, subject to tying up all of those, what I call loose ends. And David will provide additional information on that later in the call. The second thing I would like to highlight, which is very important, and again, kudos to David and the team, is that One Belmont, which is currently the flagship project that SRF is executing on, has now, has all 5 floors effectively fully leased. If you recall, some quarters ago, we were saying that we would like to wait before we get closer. We like to wait to wait before leasing out the last floor because we wanted to get closer to the end of the project, and we were able to get a tenant who came in and satisfied our requirements, and so we're happy to report that the building is now fully leased, quote unquote, and the next step is just to get to completion stage, which we're tapping at the end of September for that. So we'll invite most of you who can make it to the unveiling and the launch when it's ready and fit for purpose, in due order. Third thing is the book value of SRF, and I know that this is a very touchy issue, at least with me. The company's book value is $21.82. We have a lot of raw real estate sitting on that we'll obviously optimize those, but the stock price is trading maybe half of that value. Obviously, as we go through time and we exit and rechannel capital and raise new capital, etc., if the stock price remains, where it is, we'll obviously take action on that, because it's, I kind of have live assets on the ground that you can go feel, touch. Some of them are going to start earning income. We're exiting some of them, getting back our capital to redeploy, and the stock price does not bear any relation to at least the book value. Doesn't make sense to me, but many things don't make sense. And the last thing is, touch on the fact that the portfolio is now above 14 billion. So we continue to push very hard to unlock value in real estate assets. Of course, everybody knows that we had 2 years worth of COVID dealing with, which created a lot of logistical issues and challenges. So happy to say that we are now past all of those issues, which would have impacted some of the projects. But at least now we don't have to worry so much about those big unknowns that even up to late last year and early this year were substantial problems in terms of getting material and delays, etc. So moving on to the actual financial highlights, it's now the trajectory is similar to the first 2 quarters, obviously, and the main driver for this, so total investment income was 2.7 million, which is way lower than what it was same period last year. And the main driver for this is effectively during the 9-month period that we are reflecting on, we would have increased our debt to continue financing our activities as a bridge to exiting projects that we have that are close to completion. So effectively, we have a timing issue, and so we didn't want to sit and stop, doing our projects. So what we did was to bridge it. Of course, this debt is, is really short-term debt that we have taken on to bridge the gap until we have completed and exited projects, and then we look to recycle and then re-tap our debt financing, etc. So for the first 9 months, total investment income would have been substantially impacted by a big rise in interest expense. And of course, when you take into consideration the regular operating expenses, which the majority of operating expenses is actually reflective of management fees, which are based on the total size of the balance sheet, then net investment income would have come out to be negative, primarily driven by the 2 combined effects of the operating expenses for a 9-month period, plus the fact that net interest income would have jumped substantially. So overall, that would have resulted in a net loss of 465.1 million versus a net loss of 197.5 million in the similar period last year. I already spoke about the book value per share. So that net loss results in a negative earnings per share of $1.42, versus a loss of 63 cents last year. I'm gonna go through key highlights on another slide, but for now we had an unrealized loss of 88.4 million in terms of exchange rate, because due to the movement in the exchange rate from about 150 mash to 155 high. Of course, the currency has been trading within a wide band, anywhere between 150 and 155 since the start of 2023, and we expect that that is going to continue for a little while. So if we move to the results for the actual quarter itself, for the quarter we would have suffered a loss of 6.7 million Jamaican dollars versus a gain of 29.6 million for the similar period last year, and the same thing would have been the driving factor. Again, just to rehash, interest expense would have jumped because we took on substantial debt to bridge our continued investment deployment, while at the same time we only value real estate assets when we have exited, or when we are exiting, or having exited, or at the end of the financial year. So come the end of the financial year and the various exits that we are doing, we should see the financial statements look different from what they are looking at the moment. Net investment income, same story, a loss of 123.5 million versus a loss of 65 million last year, and then overall net loss of 163.2 million for the quarter with a 72.7 million. And that translated into earnings per share of negative 0.50 cents versus negative 23 cents last year. And during the quarter, the unrealized FX loss would have been 41.1 million versus a gain of 10.78 million last year. And again, this is due to movement in the exchange rate during the respective period. On to the next slide, just to highlight what I was saying before, you can see interest expense would have more than doubled relative to last year, and you would have seen that during the intervening period relative to, say, the financial year end, we don't have any substantial movement in the joint venture investments or gain on investment property due to the nature of how we account for real estate assets. Operating expenses, I went through that already. Fair value, we had a fair value loss of 46 million versus a gain of 22.9 million last year, and that is related to these instruments or profit sharing real estate investment notes that are used to finance third-party real estate transactions. And of course, as interest rates continue to move higher, the value of these assets will come down. So I think that's this slide highlights what I was mentioning on the previous page. And of course, when I get to Q&A, you can ask any question that you want on the income statement. Next, in terms of how we are running the business from an efficiency point of view, we have a target threshold limit of 3.5% for efficiency, which is really just saying that, for every dollar of revenue that we generate, how much of it is going out in expenses, and the key here is to keep this below a 3.5% threshold in keeping with global benchmarks. And as you can see, since we have started the business for all the 9-month period, we have been bang within that target range. Now, because the company and that's actually your management expense ratio, sorry. Now, because the company hasn't generated any net profit, we can't measure the efficiency ratio on an internal basis, but typically what we do is we measure this using the audited financial statement, which is what really matters, and the target threshold there is to get within 45%. So the efficiency ratio is actually operating expenses per dollar of revenue, while the management expense ratio, which is what I was explaining before, is actually operating expenses as a as a percentage of the total core assets under management. So with regards to the efficiency ratio on an annual basis though, historically for the last 3 audited financial years, we would have fallen within the target, save and except for 1 year when SRF would have generated exceptional returns, which would have resulted in a trigger for performance fees, which were substantial. So moving on to summary of portfolio activity during the period, mentioned the fact that we are now at 14.32 billion in 16 real estate investment assets, up 23.4% since last year. In terms of property, and this is comprised of property investments, real estate investment notes, and joint ventures. Of course, the joint ventures do not reflect the value of the joint ventures themselves. Based on the accounting standard, it simply reflects the share of profit in the joint venture. Of course, One Belmont is a $3.7 billion investment by itself, right? So it's just a share of profit from One Belmont, and of course Mona Roy, which is another joint venture that we entered into. David will give some highlight on later on. So our property investments, which is investment property that we're carrying on the balance sheet, is now 10.83 billion, up from 8.03 billion last year. Real estate investment notes 2.12 billion, that's down from 2.38 billion. And the reason why this is down is because we have announced in the previous earnings call that we started exiting a $1 billion real estate investment note. So as we get repaid, as units are being sold off in that arena and our money is being repaid, then obviously our holdings in REINs, the value of our holdings in REINs will reduce. Now, obviously, once we have exited fully, we're going to look to redeploy capital, but that redeployment of capital is going to be gradual, right? Because you don't take up all the money and put it into a REIN one shot. You basically there's a drawdown schedule and you deploy according to what the QS report says and sign off, and that capital is deployed slowly. So over the next couple quarters, you might see a situation where the value of real estate investment notes continue to fall before it starts to rise again as the drawdown schedule start to accelerate. So you should expect that. And obviously as well, this will also affect the interest income portion of the income statement, because as we exit a real estate investment note, which is kind of a primary interest income generator for SRF, you have a smaller balance, then you're going to make less revenue from that until you start to recycle the capital into new real estate investment notes, which generate new revenue at higher rates. So that's something that you'll see in forthcoming quarters. And the joint ventures, obviously One Belmont is the bulk of this, but Mona Roy, which is something that David will update on, once that project gets underway, then the value of that will start to increase. But as we get closer and closer to the end of One Belmont, if we decide, depending on how we decide to monetize One Belmont, you could see a situation where the value could go up or it could go down as we exit, right? So that remains to be seen. In terms of deployment, we would have deployed 2.82 billion over the 9-month period, which is higher than what we deployed in the similar period last year. And this ties in with what I said earlier in terms of the amount of debt that we would have taken on, which is what you would have seen temporary, the shoot up, the increase in interest expense as we bridge these exits that we are currently undergoing as well as about to do. So overall, dry powder on the balance sheet, 165 million, down from 545.9 million for the similar period last year. This amount that we have on the balance sheet now does not include about $500 million or just under $500 million that we have for the remaining final spend on One Belmont. In terms of investment allocation, wouldn't have changed substantially from the last quarter. in terms of by real estate category or by investment category, so I won't spend too much time there. Those are really self-explanatory. We still have majority of our capital deployed in investment property, more than 3/4, which means that we have a lot of assets that we need to monetize. And again, this is why I'm saying, based on where the book value of the company is versus where the stock price is trading, yeah, it doesn't add up to me, but we'll see as we go through time. Now moving on to major projects and key strategic assets. I won't go through this slide too much because we have been presenting this. It's just a listing of our major holdings, which has remained unchanged since maybe 2 quarters now. The last asset that would have acquired would have been 58 Lady Musgrave Road, which is adjacent to 56 Lady Musgrave Road. So this is just a schedule of our holdings and our balance sheet of assets that we have. And as you can see, the location of these assets are premium real estate in Jamaica. So what I'll do now is invite David to just give us some update on the projects. So over to David.
Thank you, Jason, and good morning, everyone. The first project I'll update you on briefly is some more detail on the Spanish Penwood project. So you can see it is an industrial build-to-suit, and as Jason would have indicated earlier, we're at 99% completion. So we have achieved the certificate of practical completion, and we are actually currently in handover mode with the tenant, who are significantly advanced in their interior build-out. And as you can see, we expect to exit this by the end of August 2023. And for those who may drive along Spanish Town Road, it's right at the stoplight, the intersection of Penwood Road, Chesterfield Avenue, and Spanish Town Road. Like I say, we're on the verge of exiting this particular build-to-suit, which is an industrial project. Next slide, please. One Belmont, again, Jason would have highlighted the fact that we are at 100% tenancy with respect to the commercial floors here. The project is at 87%, and we are expecting to be at practical completion by the end of September. That's the target. As you're aware, commercial buildings of this nature, we deliver as a cold shell with all the systems functional. As I said, the exit will be managed by the investment management team here, and we remain on track and confident. For those who may drive past on Belmont Road, it is quite an attractive and architecturally pleasing building, and we are looking forward to a successful exit of this project here in the coming months ahead. Next slide, please.
Hi, David, sorry to interrupt. I got some feedback that some persons aren't able to use the Q&A feature of the platform. If that is the case, please, apologies for that. Please send your questions to justine@sygnusgroup.com. So JUSTINE@sygnusgroup.com. And apologies again for that. You can go ahead, David. You can continue.
Okay, that's fine, Justine. And I hope you all got the email address. So apologies, just to echo Justine for the technical challenges there. Justine@sygnusgroup.com for your questions, and we will process them. So on screen now is one of our strategic assets, which is a beachfront property. What makes it a strategic asset is the fact that it is beachfront. So its location, as well as the industry, coupled with the fact that we have the NEPA Development Assistance Center pre-approval to develop a hospitality-based product or a hospitality or residential-based product in this location. We have not made any decisions as yet. We are still in the midst of the value creation and due diligence process, but it is an important strategic asset in the SRF portfolio. Next slide, please. Strategic asset Lakes Pen. What makes this particular asset a strategic one? The size, 55 acres, the location, It lies at the intersection of Jamaica's main north, south, and east-west highways, and in close proximity to the port of Kingston. So it is a geostrategically well-located asset, and it also, we have NEPA DAC pre-approval to develop industrial opportunities here. And again, we have not made a decision as yet, but we continue with the due diligence and value creation process. In due course, we will let you know how we will unlock the value here. Next slide, please. Strategic asset Hillcrest. What makes this a strategic asset? Location, Kingston 6 on Hillcrest Avenue, as well as the fact that this is 3.2 acres. I'm not sure that there are many other opportunities to get 3.2 acres in Kingston 6 in this type of place. So, and as you can see on screen, we do have a short-term tenant in the location, and we are developing long-term plans to unlock the value of this particular strategic asset. Next slide, please. Strategic asset 56 and 58 Lady Musgrave Road. What makes this or these properties strategic? Number one, adjacency, 2 lots beside each other, which give us a combined 1.2 acres. Number 2, location, Lady Musgrave Road, which I'm sure by now we all know is about to be widened to 4 lanes. So location, adjacency, and of course, we also have been in dialogue with NEPA DAC in terms of what we can do here, residential or commercial. No decisions have been made as yet, whilst we continue to do our due diligence and find the best way to unlock the value of this particular asset. Next slide, please. Strategic asset 26 Seaview. Again, what makes this one strategic? Location, right at the corner of Seaview and Montrose. It's 0.6 acres. Again, no decisions have been made here as yet, but we are in the midst of the due diligence process to find the best way to unlock the value of this particular asset here. 16 Montrose. Again, strategic asset. This is part of a joint venture. As you can see, we own 51% of this particular joint venture. This is the one Jason referred to as Monad Roy, and we are quite advanced in terms of the due diligence process to unlock the value of this particular property here. And hopefully before too long, we will be able to release exactly what we are likely to do once we, of course, have made the final decision with respect to this particular property. Next slide, please. We go into the RAINs, which of course is the real estate investment notes Jason would have alluded to. The first one here in Montego Bay achieved practical completion, and we continue to exit the project through the sale of the last remaining units in this development. Next slide, please. Ocean's Edge. With respect to Ocean's Edge, the developer is currently working with the real estate board, as it's already in the public domain. So once the developer and the real estate board have reached a conclusion with respect to the resolution of the challenges, then you will hear more about Ocean's Edge. The next one is Norfolk Wassa, and likewise we are about to exit the Norfolk Wassa project as well. This is nearing completion, but we are going to be exiting the Norfolk Wassa project certainly in the short term. This rain, etc., we will be exiting the particular project here. The next slide, please. And I believe that is it. So at this point, I will hand back to Jason. Thank you.
Thanks, David. So, I mean, this is the last slide, which is just providing an update on our strategic objectives, which hasn't changed that much from last quarter. Of course, it's real estate, so until you exit a number of projects, your objectives is not going to change that much. So, I think just to highlight a couple of things, we had promised that we needed to execute and complete Spanish Penwood and one Belmont, and we are bang on target with those two. Mammy Bay and Lakes Pen are the next 2 projects that are on top. We are far advanced with the value creation process that we are going through, and of course, once we get to a stage where we can advise shareholders of what we're doing, we will obviously do that as we have always done since we started the firm. Of course, Mother Roy would have been a new transaction that would have been executed recently, and we are running full speed ahead with that transaction, which we think, you know, Mark will like what we have planned there, as David said. And of course, 56 and 58 are ultra prime location. We continue to do the maths and that, as I say. So, I mean, in terms of access to flexible capital, we continue to pursue this strategy of obviously, you know, working through joint venture partnerships. Of course, One Belmont is the biggest of them all. Monadroit is the second one that would have entered. We also will do co-developments, and we are working on a number of those. And of course, real estate investment notes, which you all know about already. So at the moment, we are currently in the exit phase for our current real estate investment notes that we have. And of course, the strategy there is to redeploy that capital at some stage and obviously pay some dividends at the appropriate time. We had promised as well to, you know, start diversifying to other Caribbean regions. We continue to build up a pipeline, but of course our first focus is to, you know, get our major initiatives that we have in Jamaica monetized, are in execution phase. Once we get to a stage where we're comfortable, then we start deploying capital outside of Jamaica. So for the time being, you know, we are squarely focused on the best risk return or risk reward assets in the Caribbean, which is really Jamaican real estate. I don't think you can get them at a better price per square foot or price per acre, rather, to acquire, or, you know, value, starting value to enter collaborative efforts to then unlock the value in. So that's why we remain here, and Jamaica's debt to GDP ratio, which, you know, is pretty incredible that we are now at about 77% and trending lower, coming from 145% not so long ago, right? And that's the reason why we took, I wouldn't say a bet, we took the strategic decision to concentrate all our asset exposure in Jamaica first, given the trajectory that we felt was going to come for Jamaica, having, you know, successfully exited the second IMF program, you know, almost half a decade ago now. So I think that will pay off over the medium term. So second bullet point here is the increased dry powder, which you would have seen us doing that from time to time. The debt increase in debt is actually, you know, would have utilized debt to increase dry powder to bridge the exits that we are doing, which of course would have impacted over the short term, the financial statements for SRF, which we expect once we exit that and pay down debt, that and go for our trajectory, the financials should look a little bit better than they are at the moment. Of course, we are in harvesting period. Our harvesting cycle is on average 3 years. We had 2 years of COVID, so we are back on target in terms of having our first harvesting period and exiting our first set of investments. And then finally, of course, spoke about prospective dividend consideration. So, you know, once we exit these projects and we have the capital on hand, obviously, we'll consider our first dividend payment. So that's something that we are still at some point during 2023, depending on whether it's financial year end or the Q1, whichever period. When we get those exits done and get back some cash, we will endeavor to start returning capital to investors who have been very patient with this vehicle. Obviously, for SRF on a go-forward basis, its financials may start to look a little bit different in terms of, for example, some of the assets that we are developing and unlocking value. In some instances, we won't exit 100% of the asset when the asset is finished. Sometimes we'll hold on to some of those assets, which will bring in lease income, and then sell the asset later on down the road, which will be within our 3 to 5 year, still be within our 3 to 5 year investment horizon. But what this will do is kind of help to bolster the financial statements to reduce that negative carry that we have during interim periods when we are unable to get any valuation gain, whether it's a JV that we're doing or it's actual raw land. It's once a year that we do those valuations effectively. So as we start to develop more and more our projects, and then we start to exit them, and we stage in the exit, meaning we might exit piece in year 1 and another piece in year 2, another piece in year 3. By staggering the exit, this will help to bolster the interim financial results. So that's something that you'll see gradually start to come into SRF financial statements, which couldn't have occurred before now, because we are not in the business of going and buying real estate that somebody else has as a finished project to then earn lease income. We will just simply hold on to some of our transactions a bit longer, earn some lease income on it, and obviously the valuation will also be higher the longer you hold onto it, because our view is not that real estate in Jamaican market is going to fall 10, 20, 30%. I don't think that that's going to happen. You might have softness in certain pockets where they may be oversupply, but overall, as we would have put in our prospectus and in our, I think, first annual report, Jamaica has a massive gap in terms of, on the residential side, demand versus supply is like 5 to 1, right, or more. And on the commercial side, it's the same for premium corporate office. One thing I'm happy to see is that since One Belmont, went head first into building, what I would call a mega structure on the Kingston skyline. I'm happy to see that currently there are multiple commercial buildings that have gone up since One Belmont would have gone. So I think One Belmont, our SRF and One Belmont team has started a trend where it's now normal to have new corporate office or new office space coming on the market, while before this was virtually non-existent and everything was focused on the residential side. So good days are ahead, and just for us to continue banging away at executing, managing our risk exposures, and delivering value to shareholders through multiple channels. So we'll take questions now.
Okay, thank you, Jason and David, for providing those insights into SRF's performance and operations. And now we're going to move into the question and answer segment. Just want to remind everybody to submit their questions in the Q&A section of the platform. We're aware that the chat is disabled. Additionally, there's an option to send questions directly to me, Justine at SYGNUSGroup.com. And we did get a few questions, so I'm going to go ahead and start off currently. All right, so the first question, what is SRF's outlook on the luxury residential space?
So David, you want to take that one?
Sure, yes. Thank you for the question. The luxury residential space continues to be performing quite well, particularly in certain locations, namely Kingston 6. What we have to be mindful of at this point in time is where we are in the interest rate environment. Although a lot of persons at that end of the spectrum are not necessarily the ones who are going to be utilizing debt facilities to purchase. So we continue to be fairly bullish in the luxury residential at the end of the spectrum, but one has to be very careful with location, the price, and of course the product itself, because you find it's a much more discerning purchaser at that end of the spectrum, and you have to basically curate the product carefully to meet the demands of that particular purchaser. And the outlook varies depending on the segment of the residential market. Obviously, low-income housing is an ecosystem on its own. You have the middle of the market has its own ecosystem, and the luxury end of the market also has its own ecosystem. And you have to understand and do your research on each segment before you can venture out. So, in summary, we continue to be bullish on the luxury end of the residential market.
And to add to what David said, anything that's luxury, that where you can see the water or smell the water, you don't even have to be on the water, then those type of assets are extremely valuable and in very short supply and very high demand. So you can do the math there, right? Those will do very well. And obviously townhouses versus apartments, but then it depends on your location and the price point and the quality of the product, right? So that's how I kind of read the market as well.
Okay, thank you, David and Jason. So moving to the next question, when is SRF likely to exit Spanish Penwood relative to practical completion? I believe David could take this one.
Yes, certainly. The exit, as Jason highlighted at the start of the presentation, is planned for August 2023. As we indicated, we are actually in the handover mode to the tenant as we speak. So the process to exit is far advanced in terms of the handover, but the final sort of transactions and processes is what Jason indicated we're aiming to have concluded by August 2023.
Okay, thank you, David. All right, so moving to another question. One Belmont is 87% completed, headed for completion later this year. Where is SRF in terms of signed agreements? And we have to modify this one a little bit. I think they meant, and also with respect to exit with institutional investors.
So, as I would have mentioned very early, the building is effectively fully leased, right? We have all 5 floors, 79,000 square feet of it have agreements to lease, with effectively with minimum 10 years in hard currency and are indexed to the US dollar, and all of them are also renewable. So that's where we are with that. With respect to exit, we're still mulling over that. When the building is done and people can go in the building, so I'm not talking about when the handover has taken place to the tenants, because each tenant has to do their own interior build out, right? So, and you have to allow for maybe 3, 4, 5 months for that, right? So when the building when tenants are in the building, occupying the building, and you can walk into the building and see the people in the building at work, that's when we are, we're gonna be looking, well, we're already looking at how we want to exit. But from my point of view, we are thinking about doing this as a staged exit, meaning not all at once. And we want to get the best value, and the way to get the best value is when people are sitting at their desk doing what they want to do, and you go and look at the quality of what the work as well as the quality of the tenants that are occupying the building. So That's still something that we're playing around with, but certainly within the next several months, we will give that some thought. So I can't give you an exact timeline now, but certainly within the next couple of quarters, we'll mobilize that exit. Of course, subject to when all the tenants are in the building and you can physically go and look at it, because there's nothing like looking at the real thing versus looking at drawings, etc. So that's how I'll answer that question.
Thank you, Jason. So moving to the next question. Do you expect fair value gain or gains on investment property to exceed the 700 million that was reported for financial year in 2022?
That 700 million would be very optimistic, to be honest. Primarily because, for example, for one Belmont, it's not going to be completed before the end of the financial year. So whatever valuation that needs to come on that, you're going to have a valuation, it's not going to be as big as it was last time, simply because you need to get to the completion stage to then estimate, okay, what's the cap rate that I could exit the entire building for, or if you're doing it floor by floor, this floor versus that floor based on the quality of the tenant that's in it. So I would say that I wouldn't expect the gain to be that big, to be honest.
Thank you, Jason. Just to encourage everyone to use the Q&A segment of the platform, and if it is that the Q&A segment is unavailable for you, you can go ahead and send those questions to Justine@sygnusgroup.com. We do have quite a few questions, so I'm going to just go through them now. And if it is that you need clarification or you have a follow-up question, feel free to just queue up. So for the next question, you mentioned Lakespan and Miami Bay are the next planned developments. What is the expected cost to execute these developments, and how will rising interest rates impact the timeline of these projects, and when would they likely start?
Good question, right? So, and the first part about what's the expected cost, obviously we're not going to give that out. That's proprietary information. I know that there are shareholders on the line, but we can't give out that information. We still, and the truth is that we're still working through some of those numbers for certain elements. In terms of how interest rates, rising interest will affect them. Well, I mean, whether you have high interest rates or low interest rates, business still has to go on, right? So it's just for us to figure out the most effective way to get the financing to execute the transaction. While rates have gone up, the way how we are doing some of these financing, as in some instances, we may have to take a larger percentage of equity than what we would have initially envisioned, or based on the structure of the transaction, it may mean that the way we structure the financing, even if we are using additional debt, which is going to be a higher cost than what would have been envisioning when we started out, the fact of the matter is that we can utilize leverage and claw back those returns. So as well as we can use financing structures where we put in less equity and we have other equity investors coming. So there are multiple ways in which to quote unquote skin the cat. But our focus is just we have a return hurdle for every single transaction, and is to ensure that we get to that return hurdle at all times. So we're not moving unless we can get to that return hurdle. And the other point was, when do we expect to execute them? I would say that in the upcoming financial year, you will see movement on both of those transactions because we are far advanced with the planning and approvals for different things and what we're trying to do to monetize these transactions. We want to bear in mind that our objective is to monetize the assets by whichever means to generate the unlocking of value for investors. So on both of those projects, we are far advanced with our planning and work and pre-approvals and decision making, etc. But we're just not at a stage yet where we can make concrete announcements. Yeah, so whenever we are at that stage, we make that. And I think those are the three main questions that were asked, right? How interest rate will affect when we plan to start and what the cost is.
Yes, thank you, Jason. All right, so moving to the next question. How has the increase in construction costs impacted SRF, and what are the steps taken to mitigate this particular risk?
I'm gonna take that one.
Certainly, the very good question, and with construction costs being a significant input to our development or projects, it's something that we pay careful attention to. The impact, essentially, it can easily lead to cost overruns on projects. What we do to mitigate construction costs is falls along multiple lines of operation. The first one being careful design, that we are very meticulous when we sit with our design teams, and this is for development projects that we are doing ourselves. So that's of the nature of Belmont, as an example. You have to be very careful with the design. That design is one that's practical. You also have to be careful with the bills of quantities, that it is realistic, so that the numbers you put in your financial model will give you an accurate idea of your likely returns, the IRR. Also, you have to be very careful with the contract type that you have with the contractor. Another idea is that you may want to do some forward purchasing, which we have done in the instance of Belmont, where if you get information of a likely move in commodity prices, steel, lumber, and so on, then you could do a forward purchase to lock the price in, and that way you protect yourself against that or mitigate that risk of the rise in commodity costs. And essentially, it's not a single silver bullet that will allow you to overcome rising construction costs, but it is prudent management of the resources, a very good QS who has their handle upon the initial basic price list, a very well put together bills of quantities at the start of the project, so that you're realistic with the costs that you've assumed. Forward purchasing, a procurement plan to ensure that you understand the lead time for each of your items, and that the procurement is started at a point in time that will give you assurance or a very high probability that the commodities will arrive to your project site in time for them to be installed, because some cost overruns can also be by just time. It's a complex issue, and it's not a single thing that you can do. It's a multitude of things that you need to do in order to manage construction costs on any given project.
Thank you, David. All right, so we're getting close to 11. I'm going to take a few more questions. So you'd have mentioned the stock price discount and addressing it if the price remains severely depressed. Is it that there would be consideration of a share buyback or some other avenue?
Good question. So I don't want to speak out of turn, right? But obviously, we're in the business of delivering value for shareholders. That's the whole purpose of starting SRF in the first instance. And so if we get to a stage where SRF has, proven itself by exiting and monetizing multiple of its products as we are about to do, and the stock price is not reflecting reality, then absolutely, we will go through the appropriate method to, as a manager, to get the board to consider as appropriate, put the plan in front of the board and let the board make that decision. But all day, every day, SRF is not a REIT, right? It's not a real estate investment trust. We are not holding onto assets and just generating lease income and therefore not crystallizing, or monetizing the gains that we have on the property. We are de facto in the business of monetizing the gains that we have. So if I'm in the business of monetizing gains that I have, obviously it takes a while for you to monetize the gain, because it's not a bond. It's not like you're buying a bond or a stock where you can buy and sell every day, right? It takes time to unlock the value. It takes time to actually crystallize the gain. So if we are in that business, and we are actually monetizing and exiting and then recycling capital, and our book value keeps rising, but the share price keeps falling, then obviously, it would mean that the shareholders are investors, prospective investors, not wanting to buy the shares at whatever value, and those who own it are selling it at the much lower value, then obviously there is something wrong, right? And so what we would have to do is say, okay, for those investors and shareholders who want to remain with the firm, let's buy out the other shareholders who want to exit, and increase it, which would increase the value for those who remain. Because obviously, if you reduce the number of shares, your earnings per share, and your dividends per share will automatically increase. So that's how we think about it. It's not the time to do it yet, because we haven't actually proven anything yet. We haven't actually. We have two, major projects that we have done ourselves, right? Which is Spanish Penguin and One Belmont. We have only done two, and we are about to exit those. Of course, you have the rings that we have invested in, and we have two, well, effectively three others that are very close to getting to execution level, which we'll tell you about shortly, which is Miami Bay and Lake Spain and Mona Roy. So, we have those things to prove ourselves. So once we are executing on those and the stock price remains down, obviously, every board and every company who sees that situation is going to take that decision. And so we are no different.
Okay, thank you, Jason. So we have time for probably one more question. So is it that SRF will hold a floor of One Belmont to generate consistent lease income?
So good question. I'm not committing to SRF holding a floor. What I'm saying is that the way in which SRF is going to exit One Belmont, we're likely to see it not exiting all of One Belmont in one go. So it can be two. It can be, So if the question is, are we gonna hold one floor forever, for example, the answer is no, right? You don't want to hold it forever, because ultimately, that's part of the problem with book value per share and stock price. Because if I hold it forever, then I never crystallize the gain. So what we are saying is that we may hold several floors for a period of time, generate lease income, and then when it's appropriate, we'll exit it and then recycle. So the way in which we do this, of course, is, you can do it in multiple ways. We can have participation into One Belmont. or we can have direct sales. So there are many ways to do it. We have not settled on which is the most optimal way as yet, but we will we will quote unquote have at the start more than one floors that Belmont is able to generate income from for directly back to SRF, and then over time we see how we monetize the floors. Let me use the word monetize the floors, and to optimize the income, how SRF earns income and enhance shareholder value. So we'll do what we think is the most optimal thing to do, but it's not going to be for us to hold on to one floor for say 10 years, because that's not really part of our strategy or plan. But we will hold perhaps multiple floors and then reduce that down over time, and it might be a period of 2 years, 3 years, who knows, right? At the moment, it depends on if when we are trying to monetize one Belmont, the value that we want for it, we are getting it, because don't forget that as well, we're in a high interest rate environment, and sometimes investors, use short-term rates to try and value long-term assets. And we are not going to monetize Belmont based on where rates are today, because where rates are today, 2 years from now, rates may be half where they are, but one Belmont will still be earning whatever lease rate. It will be earning a higher lease rate than what it will earn in the first year. Its lease rate will always be increasing in hard currency. And so these are some of the things that will factor into what value we are selling, what value we will monetize one Belmont for, because we certainly are not going to try and monetize it because rates are very high, and therefore discounting the fact that, oh, I can take my cash and go and buy, put it on repo for 1 year and get 5% or 6% or 7%. That's not relevant for us, for the value of Belmont, because next year that 1 year repo might be 3%, 3.5%, while the value of the cash flows coming from Belmont is going to be higher. So those are some of the considerations. I know it's a complicated answer I'm giving, but I'm trying to explain it so that we understand what we are trying to do. This is not a bond, right? It's not a regular bond with a fixed coupon. This is a living, breathing asset with very, very high quality tenants, with a lease rate that is increasing over time. It's in hard currency, etc., etc. So we will always hold on to some units all the time if the conditions are right, to get some income in and then monetize later at a higher valuation.
Thank you so much, Jason. So it's now 11:03. So I do want to thank everyone who would have participated in today's earnings call. Thank you for your interest in SRF's financial performance and operations. We do appreciate all the questions, and we hope that we would have provided you with useful insights into how SRF is performing and continues to operate. Unfortunately, we're at the end of our segment today. If it is that we didn't get a chance to address your question, we do encourage you to reach out to our investor relations team so that we can address it. Also, to remind everyone that a recording of today's call will be published on our website on the investor relations section. So if it is that you need to replay anything, you can find it there. So thanks again for joining us today, and we look forward to speaking with you again on our next earnings call. Have a great day, everyone.